Hi there, Robert Wolf here with Terra Firma Business and Financial Consultants. I'm an asset coach and a tax strategist. So in this video, we want to walk through the Treasury Department's most recent released report on the IRS and an analysis of how they're doing in auditing S corporation and reasonable compensation. So this there's another video we did on a article that references this report. Go check that out. This is extremely important. As a small business owner, we need you to understand what conversations, what's being communicated out there, because you need to take action. We're a resource, and we're trying to help you understand what is being communicated behind the scenes as well as publicly as hints of what is to come. So let's go through this article. I'm going to minimize my picture here. The Treasury Inspector General for Tax Administration. Efforts to address the compliance risk of underreporting of S corporation officers' compensation are increasing, but more action is being taken. Heed, my friends, heed this words. So let's go through here. So it's a very good report and communication, just talking about some of what the Treasury Department found in this report, some of their recommendations. Okay, so that was the executive letter. Let's go through the actual report and talk about it. We're not going to go through the entire report. It's a 30-page report by any means. We're not going to go about the... So here's something to understand. S corporations are a flow-through entity in the sense that they pass income, losses, deductions, and credits through its shareholders for federal tax purposes. You need to understand that, right? Shareholders of S corporations report the flow-through income and losses on their personal tax returns and are assessed tax at their individual tax rates. This allows S corporations to avoid double taxation on the corporate income, meaning C corporations. Okay, S corporations are responsible for, here we go, S corporations are responsible for tax on certain built-in gains and passive income at the entity level. Okay, some S corporation owners may be motivated to underpay or not pay themselves in order to avoid paying employment taxes. Okay. This is key. Reasonable compensation is what the IRS talks about. So in your reasonable compensation, W-2 wages, okay? The definition of Employee Federal Insurance Contribution Act is unemployment tax, federal income tax withheld under the Internal Revenue Code, all right? As well as Social Security tax, as well as Medicare tax, okay? So this is important. All right, so let's go through here the results of their finding. Okay, a number of examination evaluating officer compensation may not align with compliance risks. So let's talk about the IRS's latest estimate in the gross tax gap, the amount of tax liability not paid voluntarily and timely. What's voluntarily? Estimated taxes. Okay, or how about I file on my corporate tax on March 15th and I file my individual tax on April 15th. How many of us corporations file an extension to our corporate is September 15th and our personal October 15th? I do, and we recommend business owners doing so. Because when you work with your tax professionals, the IRS calls them tax partners, they're inundated with tax returns, you as a business as well as all the individual taxpayers, okay? So it makes common sense to file an extension to allow your tax professional time and energy to be able to look at your tax returns accurately. It's your responsibility as a taxpayer. When you sign your tax return, you're the only one that signs it. When you sign your tax return, you're swearing that you've reviewed and the information's accurate. So it makes sense to file an extension. Is there a penalty to that? Sure, there's a little penalty, but it's well worth the time and energy. But that does not mean that the IRS doesn't recognize that as a gap. Okay, the gross tax gap is comprised of taxpayers who did not timely pay tax and timely file required returns. taxpayers misreporting amounts used to calculate tax liabilities on a timely filed return, and taxpayers not paying tax liabilities reported on a time. What's that mean? Okay, I'm supposed to file on March 15th and April 15th. I file an extension to September and October. And in that filing, I owe taxes. So guess what? I delay in paying those taxes, and I get a tax payment plan through the IRS. Okay, so now let's say we filed 2020 taxes. We're filing it now. Oh, I owe taxes. Okay, now what am I going to do? I'm going to ask the IRS for a payment plan. And so that goes off into 2022 for 2020 taxes. We're now 2 years removed, right? Year and a half. That's important. That's tax revenue the IRS is planning and budgeting for, okay? So they're not saying you can't do it. They allow you to do it, right? But they still report it, okay? It's still an issue. The IRS estimates that underreporting contributes to $352 billion in the gross tax gap, while the underpayment tax gap is estimated to be $50 billion. More specifically, the underreporting and underpayment tax gaps associated with employment taxes are estimated to be $24 and $6 billion respectively. Okay, so this is important. Now, are they saying, hey, you're bad? No, they're just saying, hey, here's the financials, here's what the situation is. Just like with you as a business owner, you're looking at your financial, looking at your business. What are some issues that that arise? What are some things that you need to think about? What are, as a business, what are you doing as a management team in understanding your business and the economy or the environment or your particular industry? You need to know that. So is the IRS. That's all the Treasury Department is saying here. Okay. So, the IRS has a work stream within its employment tax program that is focused on the issue of officers' compensation and S-Corp. This employment tax work stream has realized average results of approximately $17,000 per return. That's not a whole lot of money when you think about it, right? Let's see here. The employment tax workstream has realized average results of approximately $17,000 per return when examining employment tax returns associated with S-Corp taxpayers, as shown in Figure 1. Okay, so here's the figure, what they're showing over the 16, 17, and 18 years respectively. The determination of whether compensation paid for services rendered by officers is reasonable is based on facts and circumstances of each case, which is true with the IRS. Reasonable compensation, okay? And that's different with each case or each business or each taxpayer. However, the IRS advises us that its employment tax examination generally addresses officer compensation cases where the officer was not treated as an employee and or amount of wages reported on the employment tax return was unreasonably low. Reasonable compensation cases would arise more often in connection with income tax deduction cases. Here's the thing. The current field auditors are not focusing in this area. They're focusing other line items on the tax return. What do you think is going to be corrected now? This is why the Business Protection Program exists. For, yes, corporate minutes to document what your corporation is saying, but what's reasonable compensation? What is my methodology and calculation to prove what am I doing? So when this field auditor now is going to look at this line item, you have a report that's saying, hey, based on what we are reporting as my duties and my tasks and the time associated with that, here's what I'm being paid based on Bureau of Labor Statistics, based on census data, based on my county and state research data as well. That's all. That's all you need to show. Okay? Not, oh, my CPA said this. Okay? If you're a tax professional reading this, your gut feeling is not a methodology and calculation. Okay? Your taxpayer, your client, is at risk. So we need to have a report, a methodology, and a calculation. That's what we provide in the Business Protection Program in the Reasonable Compensation Report. Okay? It's important. That's all the IRS wants you to do is show reasonable effort that you're trying. That you're trying to pay the right tax, your fair share. We're helping to define that. Okay? That's the key here. All right, so officers' compensation is rarely evaluated during field examinations. That will change. Trust me. Why? Our analysis of Forms 120S process in 2015 through 2017 identified 4.4 million returns, 30% filed as S corporations with only one shareholder and no officer compensation report. 30% out of 4.4. Hello. How much tax revenue is being lost there? How many Social Security revenue? How much Medicare revenue? How much unemployment revenue? That is a lot of dollars, folks. So we know this. The IRS's examination rate of officer compensation does not align with potential risk. They're showing all this risk, but what do you think the field agents are going to start doing? What do you think the IRS is going to... government has given IRS $80 billion to update their systems. And part of that is audit teams. Okay? So this is very important. All right. What is the EOAD? It provides data that tracks examination results by issue. The data can be used to enhance the ability to identify specific areas of non-compliance based on examination results. This is the IRS's system, database, that you plug in information. It's not telling us what we need to do, okay? So they're going to start focusing on areas, what they call it, potential risk. Potential risk, okay? So we need to understand that as business owners. Although the IRS provided reasons why officers' compensation was not adjusted in some cases, we as the Treasury Department do not agree that all of these reasons should preclude an examiner from pursuing the issue. So how do you fix that? You trained field examiners. You fix the hole that has a gap. For example, we believe that officers' compensation would continue to be a productive issue in excise tax cases or in instances of corporate bankruptcy. They're going to focus on this area. The IRS is expanding its S corporation examination efforts. However, coverage of this issue can be improved. All right. I'm not going to go through the whole report. If you want to read it, we'll give you a link to it. Business owner, tax professional, tax partner of the IRS, center of influence, whoever you are that is watching this video, please read between these lines that the IRS and the Treasury Department are giving us. They're speaking to us. They're going to focus in this area. You need to be proactive. You need to be focused. Go grab your 1040 tax return, read the line right above where you sign. By the way, you're the only person who signs, and when you sign, you're agreeing that you reviewed and agree with the information. So when you get examined at whatever point in time, it is random. But now they're going to start bumping up the randomness. Just be prepared. That's all. You may never be called upon. You may not fall into that randomness. But doesn't it make sense to be prepared just in case? Isn't that why you have auto insurance? Why you have other things in your life is to pay for things just in case something to occur? This is such a minimal issue and action that you need to take. The Business Protection Program is that action. We help you take these actions without you having to spend a ton of time, without you having to be responsible. We have a report that allows you to say, hey, my report says this. What if your profit is such to where you should be receiving reasonable compensation at a higher level? Well, guess what? The Social Security threshold is $142,800 of W-2 wages. That's where they cap out. Maybe if you're not taking compensation, reasonable compensation, and your business can support that financially, maybe you should raise your threshold to that. Why not? Let us help you. Let us help you. My name is Robert Wolf. I'm with Terra Firma Business and Financial Consultants. I'm an asset coach and tax strategist, and we're here to help and support you. Thank you so much for your time.